The safe prison. Most people think a paid-off house is a financial fortress. I'm here to tell you it's actually a prison. Picture this: $500,000 buried in a metal box in your backyard. It's safe, no theft. But you can't spend it, invest it, or if you lose your job, buy groceries unless you sell the entire backyard. This highlights a critical financial blind spot. Many are conditioned to chase a debt-free home, unaware of the opportunity cost. This is exactly what happens when you rush to pay off your home. You take liquid cash, which is freedom, and turn it into illiquid home equity, useless until you sell. You become house rich and cash poor. Sitting on wealth, but you can't eat drywall. Today, we'll prove why staying in mortgage debt might be the safest, most profitable financial move you can make in 2026. This isn't about promoting reckless debt, but smart, informed financial optimization. Segment 1. The 1980s versus today. Context is king. Where did this obsession with paying off the mortgage come from? Why do advisors scream to be debt-free? It comes from history, the early 1980s. In 1981, mortgage rates hit over 16%. If you had a mortgage then, every extra dollar paid gave a guaranteed 16 to 18% return. That was an incredible return, making paying off your house the best investment. But that is not our reality today. Here in 2026, mortgage rates hover around 6%. Many have 3% or 4% loans from a few years ago. If you aggressively pay down a 4% mortgage, you declare, "I am happy earning a 4% return." Meanwhile, the S&P 500 historically returns 10%. By choosing debt repayment, you're paying a fear premium, letting nostalgia for 1981's economy destroy your wealth in 2026. The wisdom of one generation doesn't always apply to the next. Context is king. Segment 2. The spread strategy, the math. Let's get nerdy with arbitrage, or the spread. Imagine you have an extra $1,000 a month. Two choices. Option A, the peace of mind path. Send $1,000 to the bank to pay down your 4% mortgage. You save roughly $40 a year in interest. You feel good, attacking the debt. While safe, your equity remains locked in the walls of your home. Option B, the wealth builder path. Make the minimum payment and invest that $1,000 in a low-cost S&P 500 index fund. Assuming a conservative 8% return, that money earns $80 a year. This creates a $40 net profit over the interest saved, allowing your capital to compound and stay liquid for emergencies. The difference, $40 saved versus $80 earned, doesn't look like much today. But wealth is built on compounding. Let's fast forward 30 years. The person who rushed to pay off the house, option A, has a paid-off house. Great. But their investment account is tiny because all extra cash went into the home. The person who played the spread, option B, also has a paid-off house, loan term ended naturally, and a portfolio worth over $1.3 million, assuming $1,000 per month at 8% for 30 years. Look at that gap. Same job, same house. But one person has $1 million more in liquid assets. Why? Because they put money to work at 8% instead of burying it at 4%. This illustrates the profound impact of smart capital allocation. Segment 3. The danger zone, discipline. Now, a reality check. There is one major flaw in my argument. But what if I spend the money instead of investing it? This is valid. The math only works if you invest the difference. If that $1,000 goes to a new car or vacation, you lose. You end up with debt and no assets. This strategy demands financial discipline. It's for the money opulence community. If you know you have a spending problem, lock your money in the house. Forced savings is better than no savings. But if you have the discipline to automate that transfer to your brokerage account every month, you are mathematically punishing yourself by paying off the house early. The choice comes down to self-awareness and commitment to a strategic financial plan. Segment 4. The liquidity shield. Here is the biggest irony of personal finance. Debt-free people are often more fragile than investors during a recession. This might sound counterintuitive, but it's all about liquidity. Let's say a major recession hits. Markets crash, jobs are cut. Person A has a paid-off home, $500,000 value, but $0 cash, having put every dime into the mortgage. They lose their job. They still owe property taxes, insurance, and need groceries. No cash. Can they get a HELOC? Unlikely. During crises, banks freeze lending. No income makes them high risk, regardless of equity. Their fortress offers no ready cash flow. Person B still has a mortgage, but $200,000 in a brokerage account from focusing on liquidity. They lose their job. Stressful, yes. But they can sell a small, strategic portion of assets to cover mortgage and groceries for years. Who survives the storm? Person B. Cash is oxygen. Equity is just a number until you sell. Don't suffocate yourself just to ditch a payment. Prioritizing liquidity is paramount for true financial security. Segment 5. Inflation is your ally. Stop fearing a 30-year loan. In a high-inflation environment, a long-term fixed debt is an asset. We all hate inflation at the grocery store. But if you have a fixed-rate mortgage, inflation is your best friend. Your mortgage payment is fixed, say $2,000 a month. In 2026, $2,000 feels like a lot. But in 2036, thanks to inflation, that $2,000 will have the purchasing power of maybe $1,500 today. It gets easier to pay every year. Your income should also rise with inflation. You borrow expensive dollars today and pay the bank back with cheap, inflated dollars later. The bank loses. You win. Why rush to give them expensive money now? Let inflation eat the debt for you. Segment 6. The Walk-Away Fund. So what's the solution? Change your goal. The goal isn't $0 debt. It's having enough assets to pay the debt if you wanted to. I call this the Walk-Away Fund. Instead of sending extra payments to the bank, open a dedicated brokerage account. Name it Freedom Fund. Every time you feel the urge to make an extra principal payment, put that money there instead and buy a broad index fund. Watch that fund grow. Eventually, the balance will meet and surpass your mortgage balance. You might owe $200,000 on the house, but have $200,000 in the fund. Congratulations! You are now mathematically debt-free. You could write a check tomorrow and clear the loan. You have the security. But here's the trick. Don't pay it off. Keep the fund growing. Keep the liquidity. If you pay off the house, that money is gone. If it's in the fund, you control it. Control is wealth. Don't let emotions or outdated financial dogma override sound, calculated financial math. Banks want you to pay early because they can re-lend your money at a higher rate. Don't do them the favor. Build your fortress with liquid assets, not drywall. Keep your cash, grow your spread. In my next video, banks don't want you to see this mortgage math. I'll show you how banks profit when you don't understand how mortgage math really works. This video exposes the exact numbers hidden inside long-term mortgages, especially 40-year and 50-year loans. And why an affordable payment can quietly turn a $400,000 home into a $1.2 million debt trap. Most homeowners never see this math, and that's exactly how banks want it. You don't want to miss it. See you in our next video.